This is episode 220 of Zen and the Art of Real Estate Investing with my guest, Erik Oliver. Erik is the Vice President of National Accounts at Cost Segregation Authority, and therefore, and with his background, is a cost segregation expert. Erik, welcome to the show.
Thanks, Jonathan, for having me. I'm glad to be here.
Yeah, I love to give these intricacies help to investors because there's a lot of investors who've gone through their whole career and never even heard of cost segregation. Is this something that obviously you've become aware of over the years in the business?
It is. So, funny story. When I applied for this job about 8 years ago, I had no idea what cost segregation was. Um,
Yeah,
I invested a little bit just on some single family homes. My background is in accounting and kind of my career, I've always been in business development type jobs. And so
yeah,
I came across this job where they were looking for somebody with an accounting background in business development. I'm like, well, this is a unique niche and
yeah,
kind of checked all the boxes. So before I applied, I had to go Google and YouTube, what is cost segregation? And
yeah.
so I myself hadn't heard of it, but it has become more and more popular over the years, especially with some of the changes to the tax law has made it a lot more favorable for all types of investors. And so definitely becoming more and more popular.
Yeah, I mean, it's obviously a tax savings technique, but I grew up with a dad who was an investor who also worked for the IRS, and I never heard of it. So it's interesting that these things that have kind of been around because the applicable laws to be able to do this have been around for a while, right?
Yeah, they have. And it's just actually, if you're not doing cost segregation, you're actually doing it incorrect. However, the IRS isn't going to come after you and say, hey, you're not taking enough depreciation. You should be taking more because that's just money out of their coffers. And so they kind of let it slide. But technically, if you read the tax code, you should be depreciating certain assets over certain useful lives. And when you don't do it that way, technically it's incorrect.
Who needs cost segregation? I think that's the thing that everybody thinks. They think maybe they're too small. But I've found over time that most people can use it in some ways, but it's obviously more effective for others who have maybe more properties or something different.
Yeah, no, I mean, cost segregation can be used on any revenue generating property. So to kind of give you an idea, we've done everything from basement apartments in San Francisco all the way up to large ski resorts and resorts, hotels, casinos, those types of things. So everybody can utilize cost segregation. Now, whether or not it creates a tax savings is dependent upon your facts. So
Yeah.
for example, in the past, when I first started, cost segregation was really for your larger institutional investors. So you got to have a hotel, casino, apartment building. Um, then in what was it, 2017, 2018, with the Tax Cuts and Jobs Act, they enhanced some of the provisions around bonus depreciation, which bonus kind of puts cost segregation on steroids. And so it increases the benefit. So once that happened, cost segregation became more applicable to smaller investors. So like I said, we do a lot of single family rentals where maybe you buy a $300,000 home, and it's not uncommon to get a $60,000, $70,000 write off from that home by utilizing cost segregation and taking advantage of some of the bonus depreciation rules around cost segregation. Now, just because we create a $60,000 deduction, Jonathan, doesn't mean that you can necessarily use it. And so that's another piece to this is we in our company, we create these deductions, but we also want to partner with the client's tax preparer or tax strategist to see, well, what does this $60,000 deduction mean to Jonathan? Well, Jonathan is a doctor. Jonathan has W-2 income and no passive income. And so Jonathan doesn't really need a $60,000 passive deduction. Because remember, you've got to use passive deductions to offset passive income and
Yeah.
active deductions to offset active income. So just because you have real estate doesn't necessarily mean you need to do cost segregation. One of the nice things about cost segregation is you can kind of just keep it in your back pocket. You don't have to do it in any given year. You can kind of pick and choose the years that you utilize cost segregation.
Yeah.
So we work very closely with investors and their tax strategists, tax preparers to figure out, okay, we've got this $300,000 single family rental. It's going to kick off a $60,000 deduction, give or take. When is the best time to utilize it? Well, Jonathan's in a low tax bracket this year. He doesn't have a lot of passive income. So let's not do it this year. Okay, fine. Well, next year, Jonathan sells a property, has a large capital gain event, and all of a sudden there is a need for some additional deduction. And so, cost segregation, again, I've seen all types of investors, your large institutionalized investors, smaller investors where it's their first property, but it's generating a lot of cash flow. Maybe their spouse can qualify as a real estate professional, and so they can utilize these deductions. Um, it's kind of wide open in terms of who can utilize it.
Are there any asset classes that are just must do for cost seg? I mean, because it seems like you can do it for almost everything, but it seems that it would be highly valuable for apartment buildings, say. And now I've seen a lot of people with short term rentals doing it to some context because of all the stuff that you're putting in there to make it so nice.
Yeah. So we can have two questions or two
Yeah.
answers. Well,
Yeah.
let's
Yeah.
talk short-term rentals real quick because that's a unique category. So short-term rentals, I think the reason we're seeing a lot of short-term rentals being cost segregated is if a short-term rental, if the average stay is less than 7 days, which it typically is, and if you can show that you materially participate in the management of that asset, those deductions no longer are passive, they become active. And so a lot of people, I'll give you a real life example. I'm a W-2 employee. My wife works in the school district. We had a tax problem at the end of 2022. We were going to owe some taxes. And so we went out and bought a short-term rental at the end of 2022. And the reason we bought a short-term rental at the end is that we wanted to do a cost seg study and use those deductions to offset my active income.
Hmm.
Oftentimes people will say, well, you can't use real estate deductions to offset your active income. But in this case, I manage that short term rental. The average stay is less than 7 days. So basically, the IRS looks at it as Eric and his spouse are basically owning and operating a hotel business per
Yeah.
se. And because we're actively managing that, those deductions can be used. So we did a cost seg study that created a $140,000 deduction that I was able to use to offset 140,000 of my income. Again, you take 140,000 at a 37% tax bracket, that's an $80,000 tax savings somewhere in there.
Yeah.
Um, and so that's why I think we see a lot of short-term rentals. Short-term rentals are a good class. Um, kind of again, as I mentioned, average is about 30%. Your industrial buildings, maybe a big empty warehouse might
Yeah.
get 25%. Your multifamily, where you've got a lot of appliances, flooring, cabinets, those types of things, they might get 30 to 35%. There are two or three unique categories that just blow it out of the water. One is car washes. I don't know if you've seen, I don't know about where you're at in New Jersey, but here in Salt Lake, there's car washes going in on every corner. Part of that is because of the deductions. So when you buy or build a car wash, what are you really buying or building? Well, you're buying land improvements, curbs, gutters, asphalt, concrete,
Yeah.
landscape, and then you're buying equipment. And both of those are short life assets that are eligible to be accelerated or depreciated at a very fast rate. So it's not uncommon. There was a time where you could buy $1 million car wash and get a $900,000 deduction that first year. And so car washes are unique. Gas stations are another unique category. When you buy a gas station, as long as you sell more gas than you do convenience store goods, which typically most gas stations
Yeah.
do.
I hope so.
Yes.
I mean,
The only time we ever see that it's a problem is like one of those real rural ones where there's one pump, and they're not selling a lot of
yeah,
gas.
and and it's like a good Wawa or something, which that
Yeah.
would make sense. They would have a lot of pumps, but
Yeah. But most gas stations, as long as they're selling more gas, that whole gas station gets treated as a 15-year asset, which means it gets depreciated at a much faster rate, especially when you tie bonus together. And then the other one would be mobile home parks. So again, when you're buying a mobile home park, what are you buying? You're buying dirt and
yeah.
cement pads and trailer services, basically. Uh, and so when you buy $1 million mobile home park, you're buying $1 million worth of short life assets oftentimes. And so they can be accelerated and depreciated at a faster rate. So those are kind of the three outliers: car washes, gas stations, and mobile home parks. Everything else other than that's usually between 20 to 35%.
For those of us who are invested in syndications, it's really important that the GPs are doing cost segs on their properties because that depreciation that they can take can trickle down to us as LPs. Am I right about that?
Yeah. Yeah. Typically it just flows down through the K1. So you'll get a K1 with a big negative number that says, hey, you made, negative $80,000 on your investment. You take that 80,000 and offset income from somewhere else and pay no tax on it.
Yeah.
Yeah, it's definitely important that and most good syndicators they're doing cost seg. They should be if they're not.
Yeah, but a good tip for people who are looking to get into syndications, and we always say you want to vet the operator. That's a great question to ask. Are you planning on
Yeah,
doing a cost seg? Because the savings for everybody across the board is going to be huge on that.
yeah, absolutely.